Okay, well, good morning, everybody. My name is Susan Wager. I'm the Executive Director with the MMSA. So I will now turn it over to Betty Gibbs.
Hi, everybody. I just want to say welcome to everybody and welcome to Chris Berry, who agreed on fairly short notice to give this presentation. Chris is president of House Mountain Partners, and he's been an independent analyst since 2009, and his focus is on energy metals supply chains, and that includes lithium, cobalt, graphite, nickel, copper, vanadium, and rare earths. So go ahead, Chris. Thanks, and thank you for being here today.
Absolutely. Thank you for the opportunity, Betty and Susan and the rest of the MMSA. I'm really happy to have the opportunity to share a few ideas and thoughts with you and everybody else who has taken time out of their Friday morning or Friday afternoon, depending upon where you are, to hopefully engage in a discussion here, a discussion around the necessity and the importance of domestic battery metal supply chains. Why talk about them? Why worry about them? Why develop them? As Betty had mentioned just a little bit about myself, I've been active in financial markets for about the last 20 years or so, and about 10 years ago broke away from the traditional sell side with the idea of building my own independent research platform, which has really developed into an advisory and a consultancy focused on this idea of energy metal supply chains. So yes, as Betty mentioned, I look at supply and demand and pricing dynamics really along the upstream portion of these supply chains that are set to become much more dynamic and more importantly than that, much larger, I would argue, out over the next 10 years. And so typical clients for me would be hedge funds. So I do a lot of work with the investor base, trying to really understand the growth dynamics and also the challenges to growth. Mining companies, corporations, and a lot of work actually these days with academia. So a lot of different areas, a lot of different stakeholders that I work with. And so I think this presentation will actually be available after this. So, happy to take any comments or questions that we don't get to today. Now, in terms of an agenda, look, we could spend hours just talking about supply chains or just talking about any one of the metals that Betty had referenced beforehand. But what I'd like to do is just take the next 25 minutes or so of your time and really address or start to address three questions, okay? And you can see them here on the screen. Number one, what is the state of play? In other words, why are we talking about critical metals? Why are they in the news? What is the big deal? What is the issue? What's at stake? Secondly, what is the competitive landscape? Again, for all of the talk around resilience of supply chains in the wake of COVID, and building something more regionalized here in the United States or in North America, we're not the only country or part of the world that's concerned with this. And so what's going on in Europe, what's going on in Asia, and again, how do we react and position ourselves appropriately? And then thirdly, really tying back into the title of this presentation, what is the size of the prize? In other words, what's at stake from an economic and a geopolitical perspective? What are the raw material requirements to get to a specific, electric vehicle penetration number or something like that? So we'll start to address these questions, and obviously, they're pretty deep and broad. So we won't answer them necessarily, but hopefully, my goal is just to give everybody on the call today some food for thought and to generate a lot of really healthy discussion and Q&A. All right, so state of play. How did we get here? Look, there are a number of, again, things that I think got us to this point today. But when you talk about supply chain weakness, in my view, it really is due to two factors. One is public health focused, and the other is geopolitical. Obviously, COVID really knocked the global economy flat on its back last year, and we'll talk about how the global economy has responded since then. But, I would argue that the spread of COVID, number one, and then the trade war, which still rages, quite frankly, between the United States and China, and I think is set to rage as Trump transitions out and President-elect Biden transitions in, have really thrown sand in the gears of the global economy and shown the rest of the world, not just the United States, that, hey, dependence on anything, whether or not it's medical equipment or critical metals in particular, which is of course the focus of this conversation, that dependence is a weakness. Okay, it's a bad idea, and I would argue that the trade war and COVID have really forced all of us to reckon with this weakness and put a plan in place to figure out how to mitigate some of these challenges. Now, turning to something that's near and dear to my heart, which is vehicle electrification and the build out of that supply chain in particular. When you think about the industry response to COVID, again, that's something we can discuss, but I think that, you know, when we're trying to figure out why regionalized supply chains, why fund this growth, probably the biggest event of the last 6 months, when you start talking about battery metals and critical metals, was Tesla's Battery Day. Okay, that took place out in, I believe it was Nevada, might have been California, in late September. Okay, and Elon Musk, who is known for saying a lot of things that are outlandish or you know, kind of hard to believe, quite frankly, might be a polite way to say it. You know, one of his takeaways, or one of my takeaways from the day, was when he said that Terra is the new Giga. Okay, now what he meant by that was, based on his views around vehicle electrification, battery deployment, renewables, et cetera, building gigawatt-hour scale factories is not optimal. Okay, it's not going to be enough. And so his view, and maybe you can argue sort of talking his own book, but his view is that we need to start thinking much larger, an order of magnitude larger, and thinking about terawatt-hour scale factories. Okay, so if that is true, and I would argue, you know, there's a case to be made for that, there are really 3 or 4 takeaways that I think color how we want to think about supply chain development and raw material procurement. First of all, this idea, or this phenomenon of technology-driven cost deflation is obviously going to continue. Okay, and what I mean by that is batteries, lithium-ion batteries, in terms of dollars per kilowatt hour, continuing to fall in price. And I will show some data that bears that out here in a minute. Obviously, because of scale and technological leaps, that's going to continue. So batteries are going to become more ubiquitous, which means to me that the size of the prize, the size of the market, be it for electric vehicles or energy storage, is going to get a lot larger. Okay, number one. Number two, look, obviously, if your factories are going to get bigger, you're going to need more feed. You're going to need more stuff, right? And so there's a lot of moving parts in terms of trying to forecast exactly how much lithium or cobalt or copper we may need to get to any specific threshold for electric vehicles. But by my estimates, if you're looking out to say 2025 or 2026, just for forecast EV battery demand of say 10%, so 10% EV penetration, the lithium demand will increase by a factor of 4. And again, you can see here on the screen, I would argue that cobalt demand will double and copper and nickel will triple. Now, I'm not here to tell you that copper, which is a 23 million ton a year market, is going to go to 63 million tons. What I am here to tell you that copper today, as it's used just in batteries, is going to triple in demand by 2025, at least, okay? And then just to finish the last 2 points here, and then we'll move on. I think one of the major takeaways from Tesla's Battery Day is that ESG, this idea of environment and social and governmental criteria for investment, is not just a page in a PowerPoint anymore. This is going to become a very legitimate and serious driver of capital investment. Companies like Tesla or Volkswagen have made this very, very clear that they are willing to fund mining projects almost anywhere in the world, as long as they can confirm that the copper or the lithium or the cobalt that's produced is done so in a sustainable manner. And so, you know, hammering out exactly what that means is going to be the next challenge. But nevertheless, the checkbooks will come out for those projects that can hit this ESG criteria. And then finally, again, coming back to this idea of regionalized supply chains, rebuilding them, making them more transparent and perhaps shorter. Security of supply is what really underpins this goal, okay? When you, again, I don't want to harp on Tesla, almost any major automotive manufacturer does not want a 1-year lithium offtake agreement with a miner or even a 3-year. They're looking for 5 to 7 to 10-year agreements, okay, which is something brand new for this very small lithium business trying to adjust. And so security of supply, in other words, a line of sight on sustainably produced materials, really underpins this whole regionalization strategy. And it's something that the entire industry is really focused on right now. Now, in terms of some of these drivers, just to hammer home a little bit more about what's going on, the cost deflation, as I mentioned before, is an incredibly powerful economic story. Many of us on the call are probably more familiar with it because of what's happened with respect to Moore's Law and semiconductors, but it's been relatively the same or a similar cost decline in the battery business as well. We're not here today to necessarily dissect or argue about renewables deployment relative to coal. On the left-hand side of the screen, you can see this is just data and forecasts from the International Energy Agency, sort of predicting the trajectory. And I think the trajectory is what's important here. Of course, the drawback for solar and wind and other forms of renewables is, look, they just have a lot of trouble competing with respect to the intermittency, okay? We all know the challenge with the sun not shining and the wind not blowing, and that's why batteries, and I would argue specifically lithium-ion batteries, are going to be required and become even more important in terms of renewable deployment going forward. And so what you can see here on the right is data from Bloomberg that shows, as of 2019, how we had continued to decrease in terms of the overall cost in terms of dollars per kilowatt hour. My view is that that number is probably it's going to continue to fall. There are theoretical limits here, but my view is that by 2024 or perhaps 2025, you're looking at a situation where an unsubsidized electric vehicle, okay, will be at cost parity with a similar internal combustion engine car. And that's when the tipping point really starts, from my perspective. When all of a sudden the economics line up and you can say, hey, you know what, it makes sense to go electric because the infrastructure is in place ideally, and from a pure total cost of ownership perspective, an electric vehicle just makes a lot more sense. And so more and more people are starting to figure that out. And so this is what the size of the prize looks like today and where I think it's going. What you're looking at here is, again, more data from the IEA, and it's just showing you the cumulative stock of xEVs. And so an xEV is just how I define any electric vehicle. In other words, any vehicle with a battery, whether or not it's a hybrid or a plug-in or a full EV. Obviously, China, which is at the bottom of each one of these bars, dominates the space. But, you know, in 2020, xEVs were 4% of new sales. Okay, and this is in a year where COVID really hit the whole industry very, very hard. And so, you know, if we're growing at this rate and battery pricing continues to fall, obviously the market for EVs is going to continue to increase. And I would argue that you're looking at a situation there will be at least 10% EV penetration globally in 5 years. And so again, that really speaks to the size of the prize. Now, turning very briefly to the financial markets and how the financial markets, I think, are thinking about this supply chain development and electrification thesis. What you're looking at here is a price comparison or a price performance chart between two very, very popular ETFs, okay? The orange line is the XLE. This is the most popular energy ETF right now, very liquid, lots of oil and gas exposure. The white line is LIT, and that is the battery metals or the battery technology ETF, all right? And I just would draw your, I guess, attention to this divergence, okay, that I have pointed out here. And so one of the debates that is sort of raging right now between, you know, the oil and gas, the hydrocarbon group, and the electrification group is this divergence that we're seeing with oil kind of treading water between $50 to $55 a barrel and EVs really starting to take off. Are we looking at a liquidity fueled bubble? And I'll talk about the liquidity in the system here in a minute. Or is this evidence of a secular shift? And not to sort of waffle here, but I think that both can be true. I mean, when you look at the market cap of a company like Tesla, which I think is larger today than probably the next 6 or 7 automotive manufacturers combined relative, and then you think about the amount they sell relative to those other 6 automotive manufacturers. Clearly, parts of this market are overheated, but I would also argue that, again, because of the changing economics with respect to energy and energy use, I think we're in the early stages of a secular shift, and I think that this is what the financial markets are really telegraphing right here. And so if this shift is structural, okay, and again, that's part of the debate, how will the oil and gas business generate returns? This is obviously a major employer, not just here in the United States, but all over the world. And you can see data here from the Wall Street Journal, where just through the first 3 quarters of 2020, oil and gas didn't just lead the way, but they blew any other industry out of the water with respect to write-downs. Now, yes, a lot of this has to do with COVID and shut-ins and so on and so forth, but clearly at the existing oil pricing that we're seeing today, the oil and gas business is having trouble generating returns. And so, look, they have enormous R&D budgets and they're looking for ways to generate returns and fund dividends. And what better way, I would argue, than to at least start considering investments along a domestic or regional lithium ion supply chain. I mean, the oil and gas business, any one of the super majors could become dominant along the supply chain for a relatively small amount of capital. Maybe we can get into some of those details in the Q&A. Turning very briefly to the fiscal and monetary response, and again, the rationale for the domestic supply chain build out, to use, I think it's a football analogy, it might be basketball, but the Federal Reserve here in the United States has really flooded the zone, okay, in response to COVID. So when we go, if you think back a couple of slides to the performance of those ETFs and how they just sort of bounced off the bottom in late March and really rallied, it was because the Federal Reserve effectively flooded the market with liquidity. And M2, which is what we're looking at here, is a measure of the domestic money supply, and it increased by 20% last year to over $19 trillion. So the takeaway here for this slide is not that, okay, there's a lot of liquidity sloshing around in the system and we have to put it to work. The fact of the matter is, because there's so much liquidity in the system, the cost of capital, in other words, the cost of that liquidity in terms of interest rates, is historically very, very low. And we can argue about the inflationary aspects here. It's kind of a separate discussion. But nevertheless, the cost of capital, in other words, the cost to finance a project and rebuild supply chains, has almost never been cheaper, never been lower. So again, this is just another rationale to make investments in a domestic or regionalized supply chains for critical materials. Turning to the competitive landscape. So we've talked a little bit about what various industries are doing, what the Federal Reserve is doing from a fiscal and monetary perspective. What are governments doing globally? And I like to say, when I look out there over the landscape just beyond U.S. shores, that the government Leviathan has awoken, okay? And so whether or not it's Japan or India or Australia or France or, pan-governmental bodies like the European Investment Bank, almost every single country or regional trading bloc that you can think of out there has realized that, there are vulnerabilities with respect to critical metals and, of course, with PPE and other really important aspects, or I should say sectors of the economy. And no one's really interested at this point in time in relying on strategic adversaries or other parts of the world for these important inputs to the economy. So the takeaway here is that the U.S. or North America is not the only game in town. We're not the only ones thinking about this. So you can see a lot, I think, down the road, probably a lot more competition for resources going forward, which from an investor perspective, I think, implies higher prices. Not to be outdone, of course, in the United States, despite the presidential transition that we're undergoing right now, there has been a really, I would argue, relatively aggressive move in terms of introducing legislation, whether or not it's the reauthorization of the NDAA or DPA Title III. These are Department of Defense specific aspects that, again, I don't really want to get into the detail too much today, but suffice it to say that whether or not it's those DOD type of pieces of legislations where there's focus, or what some senators like Senator Cruz or Senator Murkowski, who has actually been way ahead of everybody else on critical mineral dependence and permitting, there's a lot happening out there. And the reason is, you'll see at the bottom of the screen, according to the USGS, the U.S. Geological Survey, The United States, even today, is still 100% dependent on the imports of 18 critical metals or minerals, and at least 75% dependent on imports of 32. And so my whole fundamental thesis here is that you cannot rebuild a sustainable, resilient, self-sufficient supply chain without secure access, I should say, to the lithiums and the cobalts and the graphites and the rare earth elements of the world. And we have plenty of resources here in the United States that we can talk about as well. So it all starts, from my perspective, on the upstream portion of the supply chain. And that's what I think a lot of the legislation that you see here on the screen is designed to address over the longer term. But we cannot really wait any longer because, as we saw earlier, other countries are moving forward as well. And so what does dependence look like? This is a slide from Benchmark Mineral Intelligence, good friends of mine. And they're showing us essentially, they're comparing the Eurozone, the United States, and China and saying, okay, well, if we break down the battery metal, or the electric vehicle, I should say, supply chain across 4 sectors, what does it look like? Who really owns it? Okay, so whether or not it's mining or chemical processing, cathode and anode production, or battery and cell manufacturing, you can see the numbers speak for themselves. The Chinese, over the course of the last, I would say, 15 to 20 to perhaps 25 years, have slowly, through their mercantilist policies, really deigned to own the supply chain. Okay, and so it didn't happen overnight. And I think one of the arguments here that we also want to, or one of the factors here that we want to be cognizant of, is that we aren't going to unravel this. We aren't going to decouple overnight either. It's going to take years to do this, but it doesn't mean that just because it's going to take a long time, we shouldn't do it. We should get going. Okay, and just to finish up, raw material trend and the global impact. And again, and this is where I think people get really excited, because it does speak to the true size of the prize and the economic rationale for supply chain rebuilds and acquiring and securing access of critical minerals. What you're looking at here is a particularly busy slide, okay? But I do think that a lot of the data is very pertinent. This comes from Albemarle, which many of you on the call may know is the largest lithium producer in the world, based out of Charlotte, North Carolina. Now, what they're saying, if you look in the red rectangle, is that in 2019, by their market, okay, so very, very, very small relative to base metals or iron ore, other larger players, okay? And so what's interesting, though, and I think what's exciting, is that they're forecasting this market to triple in the next 5 years, okay? I actually would agree with that. I do think that's going to happen. I think their number is a little bit higher by 2025 than I would probably be comfortable going out loud with. But nevertheless, we are going to get to that 1 million ton a year market for lithium based on vehicle electrification and energy storage primarily. And then again, beyond 2025, looking out to 2030, I would argue that this market is going to double in size again. So the size of the prize is very, very clear based on the backdrop that I've tried to lay out for everybody today. And so you'd think that, well, geez, you know, we have a very clear line of sight for lithium demand. We know it's coming. So obviously lithium pricing, which is the real driver for financing and for investment, must be sky high. And unfortunately, it's not, okay? Well, unfortunately, depending upon when you invested and where you are in the supply chain, it has been a particularly, for those of us who are bullish on the space, it's been a particularly painful, long-lasting hangover would be the right way to put it. What you're looking at here is the price of lithium carbonate, battery-grade lithium carbonate on a contract basis. The good news coming out of the slide is that based on channel checks of colleagues of mine in China and South America, other parts of the world, we're actually on the upswing, okay? And maybe that's because of liquidity in the system or optimism around COVID or EV sales, probably all of the three. But nevertheless, I would argue that the toughest part of, I guess, the lithium cycle is behind us, and we're just on the verge of a new one. So again, making the case for investment now as opposed to several years from now, because of course, for those of you on the call who know how long it takes to bring a mining project into to fruition, I mean, it can take you 7 years from the first shovel in the ground to the time we're actually producing lithium at commercial scale. So the time for investment, I would argue, is right now as prices are on the upswing. Okay, and I hate to throw math at everybody late on a Friday. It's been a long week for some of you, I'm sure. But nevertheless, this is probably the most important slide in the whole presentation. And so, again, as I mentioned before, I get questions from investors all the time, basically boiling down to what's it worth? How much are we going to need, okay, of a given raw material? And this is an exercise that anybody can do, okay? What you need to think about, and this is just for the electric vehicle business and the electric vehicle market, you just need to make some assumptions and then do some very quick math to get an idea of where we're going to be from a demand perspective in a few years, okay? So let's just say, I keep referring to 2025. So let's say by 2025, I'm going to make the assumption, as I have earlier, that electric vehicles are at a 10% 10% penetration rate. And so what that means is that EVs are 10% of new sales in that year. I'm also going to assume that in that year, 100 million light-duty vehicles are sold. All right, so that would be 10 million EVs. I'm also going to make the assumption that the average battery size for those EVs is 50 kilowatt hours. So some larger, some smaller, obviously. By the way, today that average battery size is about 44 kilowatt hours and has been trending larger globally. And then the final assumption you have to make is, what is the predominant battery chemistry? And I'm here to tell you that there is no specific lithium-ion chemistry that is going to win. That's a whole other conversation that we can have. But for automotive, which is what we're talking about today, NMC, which is short for nickel, manganese, cobalt, which is a type automotive battery type going forward in the world. And so the weight of the nickel, manganese, and cobalt in the cathode. So 50% nickel, 20% manganese, 30% cobalt. And so then what you basically do is take these numbers that I have laid out in front of you, kind of the industry standard in terms of the amount of lithium, the amount of nickel, et cetera, for this battery type. And you just do some very rudimentary math, okay? 50 times 0.8, 50 times 0.2. And you start to realize that the size of the prize, even at a relatively conservative 10% electric vehicle penetration rate, is enormous, okay? I would remind you that we just looked at that slide from Albemarle, and we were looking at a market today across all sectors, across pharmaceuticals, across batteries, of 350,000 tons a year in size. What I am proposing to you in this slide, which again is just a theoretical exercise, I am telling you that by 2025, making these assumptions, even at a relatively conservative 10% EV penetration rate, we're going to need 400,000 tons of lithium, battery quality lithium, just for that specific 10% number, okay? Now, it's a global number. Obviously, China and the EU are really rushing forward with it. But nevertheless, this speaks to the size of the prize and the growth that I think we're going to start seeing. Basically, we are seeing today a 20% compound annualized growth rate in lithium demand out to 2025. So very, very, very positive backdrop for domestic supply chain development, given this growth. Now, to finish up, what are the takeaways? And so, look, when I think about supply chain development, when I think about the whole electrification thesis, which again is what I have devoted my career to, it boils down to the 4 Ds. And that's how I think you want to think about it. Decarbonization, again, governments all over the world are devoted to this. Decoupling speaks to the supply chain challenges that I talked about earlier. Cost deflation, and of course, demand, all of which we have touched on today. So those really color, I think, how you want to think about this business and how it's going to grow going forward. Again, as I mentioned before, I'm very confident that lithium in particular is going to triple in size and then double again out to 2030, meaning that lithium demand by 2030, 10 years from now, will be at 2 million tons per year. which is today, if you think about nickel today at 2.3, 2.4 million tons, I mean, it's roughly going to be the size of the nickel market very, very soon. What I did not really get into today, which is important, and perhaps we can chat about it during the Q&A, is project funding. Okay, again, lithium, it's always been a very small market, and project funding hasn't been a challenge because the market hasn't grown at 16 to 20% per year. It's grown at 5 to 6% per year. But by my numbers and the typical sort of capex of new lithium projects, we're going to need at least 10 billion US dollars to triple lithium market capacity in the next 5 years. Okay, now that might not seem like an awful lot of money to some of you who are, again, more familiar with copper or base metals or what have you. Some of those projects can really get close to 10 billion. Maybe not that high, but nevertheless, $10 billion in capital for a business, a lithium business that is $3 billion a year today in terms of revenue, has scared people away, and it really shouldn't, because again, what I've really tried to demonstrate today is how crucial lithium and these other critical metals are going to be to supply chain development and domestic sort of industrial self-sufficiency in the future. Okay. And then finally, again, you can pull out the cliche about a marathon versus a sprint and what we're kind of dealing with here. But nevertheless, look, we are not just competing with the Chinese anymore. Okay. The United States is now competing with the European Union. They have made it very clear as a bloc that they intend to embrace this idea of a Green New Deal and build their own versions of domestic self-sufficiency and lithium-ion battery supply chains. And so we in this country have the deepest liquid capital markets. That is, I think, beyond dispute. We obviously have the domestic resources. We, again, did not talk about those today, whether or not it's projects like Lithium America's Thacker Pass lithium project in Nevada, another great example. And we also have the political will. Again, I have studied and been focused on this industry for a long time, and I'm actually in Washington, D.C. That's where I live now, and I can tell you that, regardless of who is in the White House, there is a focus on these vulnerabilities right now, and it's something that I think we as stakeholders all should take advantage of. So with that, I will step aside. I'm happy to take comments, questions. Betty or Susan, you can handle this however you see fit. I am happy to continue the conversation. You can see here's how you can contact me. So again, thank you all for your time and attention on Friday afternoon, and happy to answer any questions that might come up.
Yeah, we have several questions, Chris. The first one is, can you discuss the dichotomy between ESG as a driver and the environmental opposition and resultant delays in permitting experienced in development of these minerals?
Yeah, I think that is one from a domestic build-out perspective. Okay, that is the biggest challenge, hands down. Regardless of who is in the White House, President Trump or President Biden, I think the industry is probably a little bit more nervous with a Biden administration from a corporate tax perspective more than permitting. I mean, I think the case for critical domestic resources has been made. I do think that there is this paradox that we're all going to have to reckon with, whether or not it's the mining companies, the environmentalists, stakeholders along the supply chain. I call it the paradox of green growth. Okay, we all want to decarbonize. We want to fight climate change, or some people, that's obviously a thorny topic. I'm not going to get into it, but there is going to have to be a reckoning, quite honestly, and a meeting of the minds. And what's probably going to happen is, because of ESG requirements, this could drive up costs for the miners. Okay. That will make the environmentalists happy. But if we want to get domestic resources built, we're all going to have to give something up. Okay. And I think from the miners' perspective, or the raw material producers' perspective, it could be higher costs. And so that's perhaps one way to think about it. Of course, the upside, if there is an upside to higher costs, is ideally that should push up raw material and lithium pricing. So as an investor, it may not necessarily be a bad thing. But yeah, that reckoning and that sort of paradox of green growth has yet to be solved. And quite honestly, I don't know if it's ever going to be solved. I think that it's just something that we're all going to have to reckon with and be willing to give and take quite a bit.
Okay, the next question is, what are the challenges, barriers contributing to capital markets being so hesitant to invest into domestic raw materials and refinement development?
Well, I think that, first of all, it's the size of these markets, okay? Lithium is 325,000 tons a year in size. It has traditionally grown, demand, I should say, has grown at about 5 to 6% per year. The market structure is an oligopoly. So you had companies like Albemarle or Livent or SQM down in Chile, or a couple of large players in China that have effectively controlled the market. Um, Capital markets professionals, finance providers, or hedge funds have been hesitant to play in this space because of the volatility, because of the lack of pricing transparency in particular. When I showed you that slide of lithium pricing, that was one price for one grade of one type of lithium. Okay, you have lithium carbonate, you have lithium hydroxide, you have battery grade, you have technical grade. It really varies. And one of the reasons why investors to date have been a little skittish, quite frankly, of lithium or of vanadium or rare earths is that there is no specific price. It's a very opaque market. That is probably, I would argue, as these markets grow in size and importance, I think that's probably going to change. There is a move actually on the London Metals Exchange to create lithium futures contracts and also do the same. Well, there actually is one in place for cobalt, but it's very, very small. So this is going to take some time, but I think that, again, as you start to see EVs proliferate, and as you start to see, again, the economics change and become a lot more favorable, and you couple that with cheap money that's in the system, that means that as an investor, your payback time is shorter and your returns are going to be higher because your cost of capital is lower. All right. So I think it's just a timing issue. I think that lithium pricing transparency is going to be a challenge, but it's not insurmountable.
Okay, the next question is, how do you see recycling fit into the battery supply chain? Are there any groups leading these initiatives domestically?
Absolutely. And it's something that's near and dear to my heart. I am in terms of full disclosure, I'm an advisor to a privately held lithium ion battery recycling company called Li-Cycle, based in Canada, and just really rolling out their technology. The challenge with battery recycling, again, it's always been about handheld, computers and phones. We haven't really had to reckon with a much larger market from a recycling perspective, and that's why several groups in China and even here in the West, companies like Umicore in Belgium or Glencore, over in Switzerland, have really been the recyclers. There are other smaller players here in the United States, but again, if you come back to some of those numbers that I put out there, by the end of this decade, you're literally looking at millions of tons of either battery scrap or batteries that are looking to be recycled, and so, or needing to be recycled. And so when you look at what parts of the world like the EU are doing, they are basically putting the onus for recycling on the OEM or on the automotive manufacturers. So it's not enough to stockpile batteries or try to reuse them for second life or just put them in a landfill, which is typically what's happened in countries like China. That is over. Okay, what's going to happen now is you're going to see a lot of the R&D that has taken place in the battery recycling sector over the last, say, 5 to 10 years start to become commercial, and it's going to become commercial because of the scale. Okay, now one of the challenges there, just as a brief aside, is that batteries themselves are getting more powerful. Okay, batteries for electric vehicles, they're lasting longer. Typically, the way that it works now is most automotive manufacturers like Tesla have an 8-year warranty on their batteries, but by no means, what we're finding is that these batteries are retaining more of their useful life well beyond the 8 years. So the question is, well, what do you do with them? I think the stopgap measure is to put them to a second life, meaning tie a bunch of them together and then utilize them in energy storage. But I actually don't think that's going to be a long-term solution, because again, if you come back to that slide that I had where batteries are continuing to fall in price, there's going to be a point where a new, more powerful battery with 100% of its capacity will be cheaper to utilize than a used battery. So those used batteries and that scrap are going to get recycled. I would think that, I don't have the number off the top of my head, but you could be probably producing maybe 50 to 100,000 tons of battery quality lithium from recycling by maybe the end of this decade. Again, that depends on a lot of different factors, but it's significant, but by no means is it going to destroy overall demand or mean that we don't need to fund mining development.
Yeah, that one of our listeners comments that the lithium-ion battery recycling will be a new industry within about 10 years.
Yeah, I think that's right. Like I said, batteries, and I'm talking my own book here, so guilty as charged, but yeah, you are going to see a tsunami, okay, of batteries and of scrap, in particular, battery scrap hit this market over the next 5 to 7 years. And 10 years from now, battery recycling is going to be a viable, self-sustaining business. And every battery manufacturer or every OEM, like Tesla, like VW, is going to have an integrated solution. So we're talking today about supply chains. Recycling is going to be part of any OEM supply chain very, very soon.
Now, here's a kind of a long comment. I'll read it. The Department of Energy funds the ReCell, that's RECELL, lithium-ion battery center at Argonne National Lab, which focuses on R&D to enable direct recycling of LIBs. DOE also funds the Critical Materials Institute, an energy innovation hub that in part is advancing R&D for materials recovery from EOL libs. So that's a comment.
Absolutely. I mean, the government response to this is nothing new. I mean, it's been around for a while, but you're starting to see, again, the economic and the commercial realities of needing to recycle this material. All of a sudden, the economics are starting to make a lot more sense. And so one of the reasons why I'm so bullish about it is just the size of this prize, but also you do have a great deal of R&D happening in both the public and the private sector.
Okay, another question. What are your thoughts on the refining side of the process? Great to mine our own metals, but we need to be able to refine them to a usable product. Do you suspect there will be capital and projects available for copper, cobalt, nickel smelting refining in the US? And
so.
This question kind of comes because we have very, very little refining capacity. A lot of metals are sent outside the US for refining.
Yep, that's absolutely right. I mean, that is something that this industry that we've talked about today is really struggling with. Again, I hate to keep using Tesla as an example, but they really have talked very publicly about these types of issues. One of which is, again, if we just use the battery business as a case study. So again, going back to Tesla's battery day, what they basically said was, look, we've got our gigafactory outside of Reno, out in Sparks, and they're going to be building another one in Austin, Texas. And their plan is to also build a cathode manufacturing facility, I believe, in Texas as well. And so, all you need is one big player like that to take that risk and show that I think the economics can work. I can tell you right now that I would argue that we'll probably have an easier time in this country building out other pieces of the supply chain, the refining and the cathode manufacturing, than we would to potentially build mines. I think that building the mine, while it's very important, it's not so much the capital intensity, it's just the time it takes from a permitting and mine building and perfecting that process, that perspective. You could build a refinery, a battery cathode manufacturing facility, depending upon the size, for $200 million, and I'll bet it would take you 2 years. So lower capex and a much faster time to market.
Okay, got a couple of questions happening. One is, given the case for domestic EV growth, can you prioritize the North American projects that may have near-term lithium production? Brine and Clayton Valley, Pure Energy and ALB versus Clay, Lithium Americas and others in Nevada versus potential in oil brines. And one other earlier comment was that there are very few quality high quality lithium deposits.
Right. So to address, let me address the second comment first. That is correct. The world-class lithium assets are all owned and they're all in production. Okay. The highest grade of the high quality hard rock asset is the Greenbushes mine, which is co-owned by Albemarle and Tianqi and and also an Australian mining company that just bought 24% of it from Tianqi. And then the world-class brine assets are in the Atacama Desert in Chile and then in Argentina. And so that doesn't mean that everything else out there is terrible. It just means that, the market is going to have to find a higher equilibrium price to bring some of those projects on stream. Now, to address the first question, look, lithium is not rare. Okay, I think there's always this idea that, gosh, I don't know, like lithium, it must be a rare metal, right? It's not found in the Earth's crust very many places. That's actually not true. To the individual's point, there's oil field brines. Honestly, if lithium pricing got high enough, you could extract it from seawater. So it's not rare. So having said that, I'm not sure if the question wanted me to kind of compare and contrast oil field brine versus traditional brines versus hard rock. The lowest cost assets in the world from an OPEX perspective are in the Atacama Desert and also in Argentina, in the Puna down there. And then the hard rock assets are somewhat higher CapEx, or OPEX, excuse me, but still very, very viable at existing prices. Now, if we look at the United States, probably the most advanced assets are the Lithium Americas Thacker Pass clay asset, which is in Nevada. That is at feasibility stage. They've submitted their EIS to the BLM and should be getting a response back actually very, very soon. The numbers there, and again, feasibility studies can be kind of priced for perfection, but it looks like they'll be able to produce lithium chemicals from clay for around $4,000 per ton. Okay, so if the brines, the world-class brines, are around $3,500 a ton, and the hard rock that I mentioned before is $4,500 a ton, and that is world-class, best in the world, there is a very compelling economic case for mine development, lithium-based or clay-based lithium mine development here in the United States. And Thacker Pass is one example. In North Carolina, Piedmont Lithium has a hard rock project, and they have an offtake in place with Tesla for a portion of that. So, the money is, I would argue, starting to look inwards. I think, to the question about oil field brines, again, it's a viable source, but it's a viable source at a specific price. And so I'm not sure. I would argue that maybe some of those resources, the brines in Nevada or the oil field brines in provinces like Alberta, are probably a little bit further off from their development perspective. I think you'll probably see clay come to market before you'd see any of those.
Okay, there is a comment. Also, brines from geothermal fields could be viable at much higher lithium prices.
Mm-hmm. Absolutely. Absolutely. There's a lot going on in California in the Salton Sea, that area. You will see, and there's actually a fair amount in Europe with geothermal as well being undertaken. It's all about pricing. And, look, we're sitting here today. I showed you that lithium pricing slide. And while there's not a specific lithium price, as I mentioned before, very roughly today, just for everyone's knowledge on the call, lithium carbonate, which is, again, one of the largest lithium chemicals in terms of size, is trading for roughly, $7,500 or $8,000 per ton. And again, it's a rough number. If there are any lithium industry professionals on the call, they'll probably disagree with that because, again, lithium pricing is all over the place. But carbonate's at about $8,000 a ton, $7,500 to $8,000 a ton, and lithium hydroxide, the other chemical, and that's actually really growing in terms of its interest and its use in the batteries. That's around $9,500 per ton, and it's on the upswing. I think in order to incentivize new supply, you need an $11,000 ton number. So we've got a little ways to go, I would argue, before you really start to see investment in greenfields operations, but we're getting there.
Hey, this is a little different question. Are downstream users, that is cathode battery manufacturers, vehicle manufacturers, more willing than they have been in the past to take steps to secure their supply chains by investing upstream?
I think that's going to be one of the pleasant surprises of the next few years. To date, and this is one of the challenges, I know we keep talking about lithium, but you could look at rare earths, you could look at vanadium, you could look at cobalt. To date, because of price opacity, because of the size of the market, it's been Chinese strategic players that have gone out and written checks to secure long-term supply. We saw an instance a couple of years ago where Ganfeng, which is probably the second or third largest lithium producer in the world right now out of China, they entered into a 10-year offtake agreement directly with Volkswagen. Okay, now we don't know the pricing, we don't know the tonnage or the product, but nevertheless, that was, to my knowledge, that was the first of its kind. I could easily see a large OEM, again, we all know the names Tesla, VW, whoever, engaging in a 7 to 10 year offtake agreement directly with a mining company. I would argue that an OEM buying a mine is a terrible idea. Okay, and I've said this for a long time. Tesla has talked about building their own mine in Nevada and just producing lithium from clay with table salt and water. Okay, and that, for a lot of reasons, that just doesn't really make sense anytime in the next sort of 7 to 10 years. But nevertheless, I think the automotive manufacturers focusing on what they do best is probably the way forward. But funding these projects to feasibility or to production, and then pairing that with long-term offtake agreements for the material is the way forward. And I think that's how this industry and the supply chain is going to evolve.
Okay, the next question. Can you comment on the very high purity requirements demanded by the purchasers of battery-grade lithium hydroxide and the fact that purchasers often have different specifications?
Yeah, this is, again, another challenge. The earlier question about why are investors hesitant to make big investments in this space? Producing lithium, mining lithium, honestly, is the easy part. Producing battery quality material at scale for any number of different customers can take years to perfect. And companies like Albemarle and Livent and SQM all know this because it has taken them years to bring additional supply on stream. So it is a challenge. When you talk to LG Chem or Panasonic or GS Yuasa or Samsung, any of the large battery manufacturers, they are, generally speaking, they're all producing lithium-ion batteries, but they're producing lithium-ion batteries with slightly different purity requirements, for lack of a better phrase. And so it's a challenge for them because they see gigawatt hour and terawatt hour scale demand coming down the pipe, and they're saying, okay, well, gosh, we know that Albemarle, the existing lithium market structure, is not going to be able to handle this demand. So they're having to look at newer, unproven producers, quite frankly, some of them that we mentioned earlier, or at least producers that have not produced at scale. And so it's a real risk for the entire industry, okay? Being able to produce literally hundreds of thousands of tons of different quality material for different customers. It's a real challenge. And, we're not sure how it's going to work out. I think that, if we're looking at 2025, maybe 2027, my view is that if we are missing on EV penetration. In other words, if it's lower than we think it's going to be, it's not because of EV pricing. It's going to be because the industry, lithium, cobalt, graphite, cathode, what have you, hasn't been able to adjust and can't produce enough battery quality material to meet demand. So the good news is the implication there is higher pricing, but I think it underscores how challenging it has been, and it will continue to be for these mining companies to hit increasingly stringent purity requirements, because as we mentioned before, battery chemistry continues to evolve as well.
We're close to our hour, but we still have some more questions, so we'll just keep going.
Sure.
And I just want to remind everybody that's still on, if you have to leave, that's fine. We will be putting the recording of this webinar on our webpage. So check back. I will send out an email letting you know when that's available. So the next question, do you see sedimentary deposits like Thacker Pass or Rhyolite Ridge providing a significant fraction of lithium supply by 2025?
Not by 2025, okay? And the reason for that is I think that they will be ramping up, or at least Thacker Pass, which still needs to be financed and built. I would argue that probably by 2025 would be ramping up. So later in this decade, I think that, yeah, it's realistic. There's a high probability that, projects like Thacker Pass or like Rhyolite Ridge could be supplying, a healthy piece of the domestic market. I mean, Thacker Pass, I think, is at phase 2. I think they're planning on 60,000 tons of lithium material, produced. And so, later on in the decade, I don't want to say for sure, I was going to say for sure, later on in the decade, I'd be pretty confident that I think you can see something like that, but probably not before 2025.
Okay, the next question. How much focus does the investment community place on a state's or a country's mining tax policies? Nevada state legislators are considering a huge increase in the Nevada mining tax in response to the pandemic budget crisis. How do you think investors will perceive this?
Well, it's a risk, right? And I think it's anywhere you go in the world, you're going to I think have that, I'll call it taxation risk, government risk, rules sort of changing. I mean, we've seen that during the last lithium run in countries like Argentina. And by no means do I want to compare us or contrast us with Argentina. I'm just using it as an example. I think that, when you have these exogenous shocks to an economy like COVID, which is unprecedented, it does force governments to figure out ways to generate revenue. I think, look, it's a risk of the cost of doing business. I would argue, though, that if you're looking at a project and you're comfortable with the management, and if they have experience in lithium across the supply chain, number one, technical experience, or also financial markets experience, and also the quality of the project. I mean, if it truly is world-class, in other words, very large and scalable, and can exist in a number of different lithium pricing environments, I wouldn't think that a tax increase would kill the project. It would certainly affect economics. I'm not here to admit otherwise or defend any of that, but I do think that if you focus more on the management and the quality of the project, the taxation, it is what it is. I mean, if you think back to almost any resource boom throughout the world, when pricing rises for materials, governments are going to want, potentially want a larger piece of the pie. And so, look, that's just a risk no matter where you go in the world.
Okay, this looks like our last question. How does the lithium market compare with other new battery technology metals such as vanadium and zinc for batteries?
It's an excellent question, and it's a good one to maybe end on, or we can keep going. But lithium ion, I'm here to tell you that lithium ion batteries will be the standard for automotive for the next 15 years, okay? That doesn't mean that lithium-ion batteries won't evolve. As I mentioned before, chemistries are changing as we speak. There are solid-state lithium-ion batteries. There's a lot happening just in lithium alone. But lithium has an enormous head start on other battery technologies. Lithium was first used commercially by Sony in the early 1990s in handheld camcorders. And so lithium has a 30-plus year track record of being used in different applications, different temperatures, different stresses, and you can't quite say the same for vanadium or for zinc or for sodium sulfur or what have you, at least not yet. You know, lithium is the lightest of all metals. It is one of the most powerful. And again, it is, you know, there are challenges there with safety, obviously. I mean, battery fires are a real challenge, but I don't see anything challenging lithium in automotive for the next 15 years. For energy storage, okay, for grid scale energy storage, pairing it with renewables, to be honest, yes, when you look at vanadium redox batteries, they are actually a better long-term solution for that application relative to lithium ion. The vanadium does not degrade. It lacks energy density relative to lithium, but it does not degrade. It's 100% recyclable, and there are all sorts of financing mechanisms in place designed to make that competitive, make vanadium redox batteries competitive with, you know, ubiquitous lithium-ion batteries. So it's a messier sort of market structure over on the energy storage side, but I don't see anything challenging automotive and lithium-ion anytime soon.
Okay, that's all the questions. So we'll stop it here. And Chris, thank you so very much for coming and doing this webinar and all of the knowledge that you've brought to us today. You had no hesitation answering any of those questions, and some of them were just like, wow. So thank you very much for coming. Susan, do you have any final words?
No, thanks to everybody for joining us, and we really appreciate your participation, and let us know if there's any feedback.
Yeah, absolutely. And thanks again to the MMSA, and thanks to all of you on the Zoom here for you know, devoting part of your Friday to this, and hopefully we can keep in touch and maybe do this again in a little while.
Yeah, that would be great. I'm sure there's plenty of other things to talk about. So,
Sure.
so I'll be in touch and tap you for more later on.
Sounds good.
Thanks a lot, everybody.
Thank you.